welcome everybody. You've joined myself, Heather Dreves, Director of Funding, along with Erik Bergman, Investor Relations.
Good morning, everybody. Thanks for tuning in.
Yeah, we appreciate everybody taking time out of their busy schedules. I know this time of year is crazy for those of you folks that have kids in school, and I don't know about anybody with kids in college, but it doesn't seem quite as hectic getting them off. My kids are a little older, but I know that people are trying to fit in last minute summer plans, and I feel like summer's kind of
gone by quick.
It's gone by very quick. For those of you folks that aren't aware of where we are in the inland Northwest, North Idaho, so we cherish our summers here. We have very long winters, so we try to get in, at least my family, any bit of outside activities that we can.
Us as well.
Yeah. So you've joined Erik and I. This is the Impact Investment Forum, so we're happy to have you. For those of you folks that are return viewers, thank you. We appreciate your continued support, and anybody that's new, we're excited to have you. We love any type of input that you folks have afterwards. If there's things you'd like us to touch on, if you like it, dislike it, we love constructive criticism. So please, let Erik and I know what we can do better or what you liked.
Yeah, I think what we're going to do starting next month is we're going to implement a chat system where we can be more interactive with the listeners and take some questions. So We'll be looking forward to that.
Yeah, I think in the past we've had that set up with our webinars where you can actually have a live chat and ask questions and interact with us. So we will get that set up next time. But again, just as a reminder, if you have questions or input you'd like to give Erik or I, you can always reach us at the office at 800-898-2717 or by email. So we're going to get started. We've got a lot to cover here. We've got some exciting things. I'm going to recap quarter 2 for our fund. We had a very exciting quarter, and we have our final numbers in, so I'm going to go over that. And Erik's going to touch base. There's a lot going on in the economy in our country right now, so I'm going to hand it over to Erik, and we'll go from there.
Thanks, Heather. So yeah, the story today, obviously, is the markets. As of about 5 minutes ago, we were down approximately 2% across the board, Dow Jones, S&P 500, and NASDAQ. The fundamentals are out the window at this point. So what you thought you knew about the stock market, that's not what's unfolding today or the past 2 or 3 weeks. Me personally, I've been a student of the markets for the better part of 20 years, and I've never seen anything like this. As of right now, this market is solely moving on 2 things. One is a China deal that is starting to look less and less likely of coming to fruition. And number 2 is interest rates. For those of you that don't know, our yield curve inverted again today. So that historically has been a signal of a recession is on the horizon. Although there are a lot of economists out there, saying that, well, this inverted yield curve is different, and this is why. So we'll kind of have to see how it pans out. But either way, it's not looking rosy. In terms of the China trade deal, China's got their hands full with Hong Kong right now, so I don't feel like a lot's getting done on that front. And I think the president is really starting to realize that these tariffs are essentially a tax on our consumer, and it is bad for business. It's bad for the markets, and I don't know about you, but I kind of see him backpedaling a little bit from the deal to try to kind of calm the markets down a little bit. But that obviously hasn't worked. So the VIX, which is a volatility index, or as some would say, a fear gauge, the VIX is up 45% in the past 3 weeks.
Wow.
Which is a lot. However, it's not completely uncommon to see heightened volatility in the equity markets in the summer months when the traders are on vacation. The volume is lower, so you tend to see a little bit more harsh swings June, July, and August. But still, like I said before, the fundamentals are pretty much out. We're trading on a few things, and we're trading ferociously one way or the other. If you've been paying attention to the markets, you're seeing 300, 400, 500, 600 point swings on the Dow every day, essentially. Beyond Meat, we've talked a lot about this company. This company makes fake hamburgers, okay? I guess it's wildly popular. It is trading at 44 times earnings. which is absolutely insane for a company that makes fake cheeseburgers.
And they're everywhere now.
Everywhere.
Yeah, they're a plant-based burger. I've actually had them, and they're actually very good. Red Robin, I think, has
Did
them
you have
now.
it?
I did. Red Robin has it. I've also heard Burger King now carries
Burger
it.
King has it. They're in talks with KFC, McDonald's, all of them. But they still lost $30 million last quarter.
Wow.
And it was one of the best IPOs this year in recent history. So congrats to them. But I'm telling you what, when this market does finally correct, they're going to feel the brunt of it. What else is going on, Heather? Some good news. The markets, even with all of this kind of pandemonium in the past month or so, the markets are still only 5% off their highs. So we've seen a lot of movement down and up, but really we haven't actually lost a lot of value in the market. If you are an equity investor and you're listening and you have a considerable amount of your net worth invested in stocks, you've got to be a little nervous. Even with us only being 5% off the highs, it's definitely a difficult time to be in risk assets.
Well, and I think that also bodes to the fact that we offer some alternatives to the stock market. I've told numerous people I've spoke with that we're not expecting you to jump completely out of the stock market and put all your eggs in our basket, but it is a great opportunity to diversify their portfolios.
It is. I mean, even if it isn't private lending, right? You're seeing the global economy move away from risk assets, right? That's why these interest rates are so low, because people need yield. They're looking for yield with safety. So if you're not looking for yield with safety, either you know something they don't know, or you're slow to react, or you just don't care. And all of those examples are fine wherever you fall, but for the prudent investor that takes a proactive approach to managing their portfolio, now would be a really good opportunity to take some risk off the table and move it into an asset class that is not as overvalued as stocks and doesn't have as much volatility. It would be very, very, very smart to do that. If you need help or if you have questions on how to go about that, call us, 1-800-898-2717. We would love to talk to you about it. And it doesn't need to be, hey, you should just be in our fund. We would love to have you in our fund, and that would be a prudent move, but we would be glad to give you advice across the spectrum. Ask yourself, take a look at your portfolio. What percentage of your portfolio is in high-risk assets? And ask yourself how comfortable you are with that allocation.
And I think a lot of people are starting to look at that. I don't know about you, but I get calls every day from people that, especially with what's going on in the markets, they're starting to look at those things, and look for alternatives. One of the things that we help people with that's become very popular is them using their qualified funds, whether those are IRA or 401k plans, and doing a self-directed custodian. And they're moving them out of the traditional fidelities and things of that nature, moving them with a self-directed custodian that allows them to invest in these types of alternative investments to diversify their portfolio. So that's something else that if you're not familiar with, self-directed custodians, we'd be happy to give you some referrals of some companies that we've had really good luck with to better educate yourself. A lot of them put on free webinars and things of that nature.
Right. And that's a really good point, Heather. There's three major asset classes out there. There's stocks, bonds, and there's real estate. I'm about to talk about interest rates here in a second. Bonds are a very, very difficult place to invest in right now. The stock market, we just spoke on that. It's incredibly choppy. Not saying take all your assets out of there, but the risk is definitely up. And then you've got real estate. Real estate, I think, is the most misunderstood asset class, meaning the average investor doesn't really know how to gain exposure in real estate outside of buying a home. This is what Heather and I are extremely good at. We'd love for you to call us, say, hey, look, I've got a lot of stocks. I want to move some of my assets that are invested into stocks into more of a real estate play. How would I best go about doing that without plopping down a huge down payment and taking ownership of a home? Okay, so we can help you with that as well. And that kind of segues us into alternative investments. The interest rate environment now is something, I don't think any of us have ever seen. I mean, there are, how about this? Let's start with this. The following countries have negative interest rates out of their central bank: Germany, Japan, Denmark, Sweden, and Switzerland. negative interest rates. So our federal funds rate right now is sitting at about 2%. The Fed cut this last month in July. They cut a quarter basis points to get us down close to 2. They're most likely going to cut again in September. It could be a quarter point. If the market keeps acting the way it's acting now, look for more of a half a point cut in September. Either way, we're going to keep cutting. The Fed doesn't really have a choice at this point. Their back's up against the wall. So you understand, this is how, I mean, there's $15 trillion in the global economy invested in negative interest rates. This is quite absurd. So literally the lender is paying the borrower to lend them money. That's what's going on right now. So for instance, in Germany, their federal funds rate is negative 30 basis points. So if an investor, you say, hey, I want to invest in the German Treasury, you invest $1 million, you're only going to get $970,000 back, and people are doing it because it's safe. So people are yield starved, not just here in the States, but people are yield starved all over the world. And that's why we're seeing our 30-year Treasury at an all-time low. That's why we're seeing our 2-year Treasury paying less than our 3-month Treasury, because we have massive amounts of money looking for yield, and the United States is still the place to provide the yield. So our 10-year Treasury right now is trading at about 155 basis points, or 1.55%, which when we think 1.5%, I mean, we wouldn't have any clients if we returned 1.5%. But that's what the government is returning. And the more inflows we see into the United States Treasuries, the bond prices are going to go up and the yields are going to continue to go down. So what does that mean for us as a private lender? It's actually quite good for our situation, because we originate short-term, high-yield debt instruments, and then we look to sell those assets in the secondary market at an interest rate spread. So in order for us to be successful, we need a strong secondary market. We need financial institutions that are looking for yield that will buy our paper and buy it quickly.
And there's plenty of them.
And the more yield-starved these financial institutions become, the more they're going to turn to asset classes like private money, and they are going to create more competition in the secondary market, allowing us to sell our assets at a better interest rate spread. So for our strategy here, it's going to work out quite good, and we should see a significant amount of inflows just because our fund yields 12.4% historically. The Treasury, the risk-free rate of return is 1.5. The difference between 12.4 and 1.5 is approximately 11. That's an 11% premium above the risk-free rate of return, and we have very minimal volatility. So that's the value proposition to the customer.
Well, and I will tell you, I mean, I deal with the note side of it also, in addition to the funds, and we have tons of institutions trying to buy notes.
Right.
And one of the things I've seen, over the years that I've been in it, when I got into this 12 years ago, it was private investors. It's your millionaire next door that likes to buy a couple notes locally and deploy his capital.
Right.
These large institutions have came in, and they don't demand as high of yields. They're happy with 7-8%, which is a benefit to the fund, because if I can sell it at a bigger interest spread, the fund makes more money. And I think the unfortunate thing is you start to see some of the note buyers being pushed out of the industry in regards to notes. But that's the perfect opportunity to get into the fund,
right? Because
essentially it's the same asset class. You just don't have the headache of it. You don't have the headache of foreclosing. You don't have to manage the collections. We do that all for you. So it's really kind of a perfect transition. We have plenty of institutional capital that want to buy the notes. Therefore, it benefits the fund. The fund makes more money, which is a great opportunity maybe for someone that's always bought notes to go into the fund in that type of environment.
Right. It's yield with safety. If there's any recommendation that I could give to our listeners, is search for yield with safety. It doesn't have to be, double-digit returns necessarily, even though that's what we've been able to achieve over time. But yield with some sort of protection built in. And that's a beautiful thing about private lending, is at the end of the day, the underlying asset securing the note is real estate. So that's what we mean by yield with safety.
Yeah. No, I think it's great. And I think it's a great segue into the presentation I'm going to go over right now. We had a great quarter. So for those of you that aren't familiar with our fund, we have the Secured Investment High Yield Fund 2 that is available for contributions, providing that you're accredited. Soon we will have another opportunity for non-accredited investors, and we hope to be able to roll that out hopefully at the next webinar or podcast. However, right now it's Fund 2 that's available for contributions, but we just finished up quarter 2. We had an amazing quarter. This fund is active in originating notes for real estate investors and buying real estate in the Spokane, Washington market. It's pretty simple. You know, we originate the notes, like Erik has mentioned a couple times, through the fund, and then we sell that risk off, and we retain an interest spread. And then we actually go typically to the local Spokane, Washington auction every Friday. However, we've started to pick up some wholesale deals that are actually a little bit better deals in auction, and we will fix and flip those properties. Some of them we just go in and do very minimal cosmetic work to it and turn them as quick as we can. So I'm going to go over some numbers. I'm pretty excited about it. It takes an entire team to manage this fund. Everything from Erik and I raising money to our amazing accounting team that, you know, is on a daily basis running numbers. And then we also have a real estate team that actually finds the deals to buy, coordinates going in and rehabbing them, and then even marketing them for resale.
Yeah, I just want to say this is the only fund I know of that gives you the private lending exposure, but also will flip, I think, what did we flip, over 60 houses year to date? The fund has flipped over 60 houses year to date, and we're only in August. So what fund can you get out there that yields 12 to give you private lending exposure, but also gives you that fix and flip exposure at the same time? I think it's a pretty special fund.
And the real estate assets that we flip through there is what juices the yields.
Right.
I mean, you can see it when you go back through historically through our returns and what we've paid out. You know, you'll see, I mean, we would prefer to have consistent growth, right? We don't like the peaks and the valleys. But when we have seen a peak, we'll look back at the numbers, and it's very clear that, you know, typically that's a quarter that we flipped more properties than we had prior to or after that. So I just want to go over a couple numbers, and we'll go through that. Now, understand we have full reports. If you're interested, we can provide you with those. Erik and I, just get a hold of us. These funds are fully audited. We hire an auditing firm out of San Francisco that comes in every year and fully audits these funds. So we keep very clean books on them, and we're very transparent. So if you'd like to look at the reports, we'd be happy to provide you with that. So hoping everybody can see this, but this is actually a snippet from the actual report that you get at the end of every quarter. So like I said, we're very transparent. If you look on the bottom line, you can actually see that for quarter 2 of 2019, we actually paid out 13.2%. We had an amazing quarter. We pay out on a cash basis, and that's an annualized yield. So right now we're targeted for year to date to hit 13.4 returns, which is pretty amazing. In the past, in 2018, we hit 11.9. In 2017, it was 11.1. 2016 was a little higher at 14.4, and then 2015 was 11.8. So this has all of our historical returns. We've really dialed in the real estate side of it. I will say that we've built an amazing real estate team. We get in these properties as quick as we can and out of them as quick as we can and do about as minimal work as we can. And one of the things to comment on is with rates being lower, that has really helped with our real estate transactions. I will tell you, when rates are low, affordability is higher, so people can actually buy a more expensive house than they probably normally would be able to if rates were high. So that always is something that we take into consideration when looking at these houses. I will tell you, we get together once a week, the real estate team and myself and 2 other fund managers, and we go over all the real estate transactions, what we're going to do with them, how we're going to market them, you know, are we going to just wholesale them, are we going to rehab them? So there's a lot of thought that goes into those. So we had a great quarter. Okay, couple other things I want to go over. This is an example, actually, of a loan that we sold that you were mentioning where we retain the interest spread. So I just wanted to give you an example of this. Quarter 2, we had a loan that was $53,900, and the note rate that we charged the borrower was 13%. We had a end lender already lined up for this before we even closed. Obviously, we didn't accept his money yet, but he'd already looked at the file, made a verbal commitment. As soon as we closed it, we turned around and sold it, and we sold it at a rate to them of 9%. So we actually retained a 4% spread. So this is what we're talking about, this interest spread. This is residual interest income coming in every month on capital we don't even have deployed anymore. So when our end lender verbally committed, we drew up the paperwork. They actually wired $53,900. The fund recouped their principal. They keep earning interest on money they don't have out there, and we turn around and we redeploy that capital.
It's incredible.
Yeah.
That could happen in literally the same day. We could originate and sell in the secondary market in the same day. We had default risk for one day, and now we're going to get 3 to 4% or even better for the next year or so.
Yeah, it's beautiful. The other thing to comment on is when we originate a note, the fund actually earns origination points,
Right.
and that's another benefit to the fund to redeploy it over and over as they continue to earn their portion of the interest spread. So I want to go back up to this because I think these are pretty exciting numbers. If you look at the top line, you can see that in quarter 2, we actually originated 47 loans. So that's the number of loans that we closed in that quarter through the fund. We actually sold 57 loans. Mm-hmm. So there's always going to be carryover, right? And it's a balancing act. I've had people look at our reports and say, well, how do you determine what you sell and what you don't sell? Everything is for sale. But one of the things that we're very mindful of the fund is balancing it, right? We don't want to sell more notes than we have notes coming. We don't want undeployed capital. So it's something we keep a very close pulse on.
Well, and bear in mind, the vast majority of our fund members invest for retirement income, right? So it is in their best interest to have stable, consistent income from the funds. As fund managers, Heather and the other two fund managers, part of their thinking in this and their thought process and the decisions of when they sell and what they sell is to keep the income streams stable and consistent for the fund member. I think that's important to point out.
Yeah, one of the things that we actually track, and it's in our report, I don't have a slide for it, is the utilization rate. Mm-hmm. So we're always looking at how utilized is the fund. We try to keep it 90% and above. We don't like to see big dips, a bunch of money sitting undeployed. But the fact that we meet so consistently, we can make changes very quickly. Mm-hmm. If I know we don't have a lot of new loans coming for origination, we can always buy more at auction. Right. So, those are things that are taken into consideration. So last quarter, we originated about a little over $4.3 million in notes, and we sold 4.8. So they're pretty consistent as far as those dollars go, and we do have historical numbers on this in here. Last quarter for properties purchased, we purchased 5 in the quarter, and we actually sold 7. So again, those are pretty consistent also. And one other thing I want to point out, last quarter, the 13.2% that we actually paid out to the members of the fund was a total of about $243,000. It was pretty awesome. It's really nice sending those checks out and getting those calls like, is this right? So yeah, our fund has done amazing. But again, it takes an entire team to run this fund and generate these kind of numbers. And we feel like we have a superstar team here.
We do.
So another example, this is a property we bought. So this is an example of a property we bought at auction. We rehabbed it and we turned around and sold it. These are pretty awesome numbers. So we bought this property for $107,000. You can see there's snow on the ground. So this was actually purchased probably in quarter 1. Mm-hmm. We rehabbed it and there were some holding costs. We paid about $11,000, including all of those. Sold it for $162,852. Now, keep in mind, you're going to see the profit of $24,000 and some change because there's closing costs. There's commissions to agents and things of that nature. But overall, with a profit of over $24,000, our annualized yield was 73%. We held this property for 124 days. So you can see how quick these properties come in, get in the system, get them rehabbed, and turn around and get them on the market to sell. We've had properties sell in 45 days. It really kind of depends on the time of the year, how much rehab is involved, and things of that nature. So just a couple examples of a note and a property that we've sold. We really believe strongly that the fund is a great environment. If you're looking for that real estate asset, like Erik was mentioning, but you're not ready to, put the down payment down, manage a property, manage tenants and toilets. I manage tenants and toilets. It's not that glamorous. I've also flipped properties. It is not that glamorous. But this is a great opportunity to still be active in those types of assets, but not have to get your hands dirty and deal with all the ins and outs of that.
Right. And I just want to say the fund's target return is 10 to 12% annually. It's going to be 10 to 12% annually no matter what market we're in. In any market cycle, our target return is not going to change. Unlike mutual funds and stocks and what have you, you're looking to hedge or only lose a certain amount or just keep your losses in check. That's not what this fund's objective is. This fund has an absolute return objective, meaning no matter what's going on in the economy, our objective is 10 to 12%, period.
Yeah, and I think we've done a great job, hitting that target.
We have.
You can look at our historical numbers. They're very consistent. Yeah, we like to pay out 13%, but again, like Erik said, our target is 10 to 12%. Which is a great return on a product that's actually backed by something tangible.
Right.
These are assets. You are a member of this fund. If everything goes sideways, you as a member have an ownership in this fund. So we believe strongly in it. Now, if you're not accredited, there's still opportunity to deploy capital. We have the notes, which are still a really good opportunity. So get a hold of myself or Erik, and we can walk you through that process. We hope by next quarter we'll have a great new announcement that we'll have a new fund for you non-accredited investors. It's still going through the approval process with the SEC. It's been a long one.
It has been a very long one.
Yeah. So we hope to have exciting news next month.
Call us.
Yeah.
1-800-898-2717, 1-800-898-2717. Even if it's not about the fund, we're here as a resource, and we'd love to help you out.
Absolutely. You can also visit our website at Secured Investment Corp. We have information on there about the fund. We also have information on there about our notes. All of our notes are actually uploaded on there, so you can actually visit the website. If you have interest in any of those notes, you just click a simple button, make an inquiry, and it lets us know here at the office that you'd like more information, and we'll follow up with you right away. But again, we're here to help you. We think that whether it's through the fund or the notes, it's a really great opportunity to diversify your portfolio, especially in the economy right now and the uneasiness. Get a hold of us. We can walk you through it. We can give you more information. We're here to help you. Again, 800-898-2717.
Thanks for listening.
Yep. Have a great rest of your summer. Thank you.
Bye, guys.